Brad Williams, Frugal Finance, understanding stock risk. Every type of investment carries some degree of risk, and stocks are no exception. Here are some of the common risks associated with stocks. Stock volatility risk. If you've seen the jagged lines on charts tracking stock prices, you know that stock prices fluctuate daily and over longer term, sometimes dramatically. Size and frequency of these price fluctuations are known as the stock's volatility. Volatility can be an important measure of investment risk, both market-wide and for an individual stock. The common measure of stock's volatility relative to the broader market is known as the stock's beta, which is how a stock's volatility compares to the market as a whole. A stock that has a beta above 1 means it is more volatile than the overall market. Generally, growth stocks tend to be more volatile than value stocks. Economic and business risks. Frequently, events in the economy or the business environment can affect an entire industry. For example, it's possible that high gas prices might lower the profits of transportation and delivery companies. Inflation and interest rate risk. These two risks can operate separately or in tandem. Interest rate risk, in this context, simply refers to the challenges that a rising interest rate causes for businesses that need financing. As their costs go up with interest rate increases, it becomes harder for them to stay in business. If rates climb during a time of inflation, which often happens since increasing interest rates is a tool that Federal Reserves commonly use to fight inflation, then a company might see its financing costs climb as the value of the dollar it's bringing in decreases. Investor sentiment risk. Sometimes an entire industry might be in the midst of an exciting period of innovation and expansion and becomes popular with investors. Other times, that same industry could be stagnant and have little investor appeal. Like the stock market as a whole, sectors, industries, and individual companies tend to go through cycles, providing strong performance in some periods and disappointing performance in others. Media risk. Growth companies in particular often receive intense media and investor attention, and their stock prices may be higher than their current profits seem to warrant. That's because investors are buying the stock based on potential for future earnings, not on a history of past results. If the stock fulfills expectations, even investors who pay higher prices might realize a profit. If not, the stock price might decline dramatically. Rating risk. Any changes to analyst ratings on a company's stock, from a buy to a sell for instance, has the potential to impact the stock's price. It's possible a rating shift, whether negative or positive, causes a price swing more pronounced than might seem justified by the events that led to rating change. It could take time for the market to digest such ratings news. Obsolescence risks. This is the risk that a company's business is going the way of the dinosaur. Very few businesses live to be 100, and none of those reach that ripe age by keeping to the same business processes they started with. The biggest obsolescence risk is that someone will find a way to make a similar product at a cheaper price. Detection risk. Detection risk is the risk that the auditor, compliance program, regulator, or other authority will find problems, the proverbial skeleton in the closet. With detection risk, the damage to the company's reputation might be difficult to repair, and it's even possible that the company will never recover if the financial fraud was widespread. Legislative or regulatory risk. This is the risk that the government action such as new legislation or new regulation will constrain a corporation or industry, thereby adversely affecting an investor's holdings in that company or industry. This can include an antitrust suit, new regulations or standards, specific taxes, and so on. For example, a new rule changing the review process of prescription drugs might affect the profitability of all pharmaceutical companies. Penny stock risk. Microcap securities, sometimes referred to as penny stocks, include low-price securities issued by small companies with low market capitalization. These securities are primarily traded on over-the-counter market, while microcap companies can be real businesses developing or offering products or services. The microcap sector has a long history of bad actors engaging in price manipulation and other fraud. However, even in the absence of fraud, microcap stocks can present higher risks than the stock of larger companies. This is largely because relatively little information is available about microcap companies compared with larger companies that list their securities on national exchanges. If you have any questions relating to stock risk, comment. Brad Williams, Frugal Finance. Thanks for watching. Hope that helped. See you soon.